Is the real estate market gonna crash from 8 interest rate hikes? Stay tuned, I'm gonna explain it all for you in this week's episode of Prime Properties TV. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you joined me here today. There is so much chatter right now about rate hikes, so I want to take this week's episode to discuss the topics and give you a little bit of perspective from my side of what you may not actually know. So I'm going to break this into three components in this episode. It's going to be a little bit longer. So number one, I'm going to have a quick chat with my mortgage broker, Brady, about the terms that are actually in your mortgage contract that you probably didn't know about that can, prevent you from freaking out. Number two, how you can protect yourself from an interest rate hike if it is going to happen. And number three, how high this actually interest rate can go before something blows up. So let's address the elephant in the room. In case you did not read the headlines that were last week, it's right here. Scotiabank thinks there's going to be 8 interest rate hikes next year. Look, I have a running bet with a few friends of how many interest rates will hike before we something absolutely blow up. And to provide you some color in the situation, every year there's 8 announcement dates for Bank of Canada to say, hey, look, we're increasing interest rates or something's going to happen, right? So that means Scotia's prediction is that 8 out of 8 times that they're going to have this date, Bank of Canada's going to increase their interest rate. Doubtful. The second bit of context to this is the last announcement day, Bank of Canada did come and acknowledge that, look, they think inflation is running hotter than expected and will stop quantitative easing or money printing and will increase interest rates soon, right? So thank you, Captain Obvious. We knew that, right? So here's my take on what's going to happen. I'm 95% certain that there is 100% going to be, actually, yeah, make it 100%. There's going to be interest rate hike some point next year. It's a given. The actual question you really got to ask yourself is how many times that's going to happen. My bet is we're going to have 3 interest rate hikes or about 0.75% interest rate increase to about 1% before some part of the economy shows a sign of crack and we're going to increase it back up again because they're going to freak out. You may think I'm crazy and bullish on where it's going to be in terms of real estate prices and asset prices, but just hang on until the end of the video to understand my rationale. The math will blow your mind, but first let's cut to my chat with mortgage guy or my mortgage guy, Brady Liao, the owner of Caliber Mortgages, to talk about how to protect yourself from these interest rate hikes. It's something I bet you didn't know. Stay tuned. All right, everybody. We have Mr. Liao, Brady Liao from Caliber Mortgages, who I'd say is the superstar mortgage broker. If you're working with me or my team, you probably would have heard of him. He does, I would say, 50 to 80% of the mortgages for our clients. So welcome to the show, and thank you for randomly joining me to talk about interest rates after all these crazy shenanigans.
Yes, you're welcome. You're welcome.
Yeah, for sure. So before we start recording, Brady and I were just about to talk about this whole, 8 interest rate hike from Scotia and Tiff Macklem, the head of Bank of Canada, coming out saying, hey, we're going to increase interest rates because, inflation is much more real than they thought. So I will let you take it away, Brady. Where do you think interest rates are going?
Honestly, I don't really think it's going to go up anytime soon. Still, I know a lot of rumors and analysts actually out there not saying the same thing. But what I actually see is that you guys can actually do your own research as well, of course. What I see is that this pandemic situation is a global disaster. This is not like a one-time stock market crash like 2017, 2008, So this time, like during this pandemic, a lot of big corporations and small local governments, they piled up a lot of debts. Mm-hmm. So if they actually raise the interest rate just by a quarter of the points, the unemployment rate will skyrocket. Like a lot of companies, they are going to cry for help, right? So, So I don't really see that actually happening. The reason why they keep saying that, honestly, if you actually look back, they have been saying interest rate hike for the past 2 years already, but it's never happened, right? So what I actually what I think my own perspective is that because they have no other methods, no other solutions to contain people that have money or have equity to leverage. So instead of looking for hoping for the policy changes from governments, they actually have to say something to try to contain or slow down people that go into leverage.
Yeah, and but that's the wealth gap, right? The wealth gap keeps getting bigger.
Exactly. And the other thing is that I look at it as whatever happened in the future, like we worry about that by then, right?
Oh.
Like, yeah, exactly. It might not happen, right? So we just need to take advantage of the current situation to build wealth over this time. Like, if worst case scenario, if the interest rate really hike, then crunching the numbers again, see what is your break-even point, what is your balance point, and then you know what, if things not going well, or you don't see the real return being on par, then you can offload one or two of your properties at an appreciated value and cash out. You can cash out anytime, right? So that's how I teach my clients about taking advantage right now, that you are not completely tied up for the future anyways, right?
Yeah, I mean, it's a risk analysis, right? And just in case you guys don't know, Brady has what, like 2 decades, almost 2 decades of like financial.
21 years.
Yeah,
21
yeah.
years.
I knew it sounded like that. he's got a lot of knowledge, right? So here's my question for you. I'm taking bets. This is what I'm asking everyone. If the over and under, and I know you're a gambling guy, I understand the terms. The amount of interest rate hikes by the end of 2023 is 3.5. Are you going to take the over or the under?
Under.
Yeah, I agree with you. I think we're going to be right at 3. I think we're going to be right at 3 because it's going to blow up something by the time we get to 1%. And what people don't realize is the amount of debt we have right now is 0.25. Sorry, amount of debt we have on the interest rate is 0.25. By increasing it 0.25, effectively doubles the amount of debt servicing we have. Doubles, right? So I'll talk about that later in the video. But I want to bring Brady on because we want to talk about mortgages, right? So what a lot of people don't understand is when you have a variable mortgage and interest rate goes up, some banks actually your monthly payment doesn't go up. And Brady, can you please explain that to everybody?
Yes. So there are 2 types of variable mortgage. One is called variable rate, and the other one is called adjustable rate. So for example, TD Bank, I deal with a lot of mortgage applications with TD and Scotia. I have great relationship with both of them. So TD, the policies is that all the variable rate mortgage payment, if the rate changes, the principal and interest payment allocation will change, but the monthly payment will not. So meaning, let's say your monthly payment is $2,000 right now. Yeah. And the interest rate I got you is at 1.25%, for example. Okay. So if the rate goes up by a quarter of a point, which is 0.25%, and then the variable rate goes up by 0.25 as well, because it's actually based on prime rate. So it's 1.5 now. So instead of, so that $2,000, let's say about
35% interest, right? 65 principal, something like that right now.
Something like that, yeah. So I would say, let's say 1,200 into principal and then $800 to the interest. Yeah. So if the interest rate goes up a little bit, then the allocation will change. Maybe only 1,000 going into the principal and then 1,000 going into the interest. But the monthly payment, 2,000 will not change. That's the variable rate. But then Scotia is completely different, right? Scotia is they only do adjustable, meaning the monthly payment will fluctuate, but principal and interest allocation will stay the same.
Yeah.
So let's say 2,000 a month, same thing, $800 going into the interest, 1,200 going to the principal. But then if the rate hike, then let's say you need to pay maybe another $200 on top, 2,200 a month instead of 2,000 to keep the principal payment as 1,200, but then the interest payment will actually increase by a little bit because of the interest rate hike.
Yeah. So this is where you need to have a good mortgage broker who understands what kind of mortgage product is out there. So what you're saying is if anyone's freaking out about interest rate, but you want to stay variable, go TD because the allocation of the interest and principal changes, but your monthly is the same. But Scotia, the interest goes up and your monthly could go up, right?
Yes.
Yeah. So what happens when what happens when the interest rate goes up? What happens to the amortization after? Does it increase because you're paying down less principal?
See, with TD, the amortization will increase because you're paying down less principal.
Yeah.
Right. But then with Scotia, everything stays the same, but the monthly amount actually goes up because you're actually paying extra interest on the monthly basis. So the amortization will stay the same. The principal payment portion will stay the same. Only difference is the interest portion that you need to pay a little bit more.
Got it. So if you're on TD, do you readjust your amortization or like the amount of principal you have to pay when you are up for renewal, or like say on your next term?
Well, you know what? You can adjust it or you don't need to. Okay.
Okay.
I'm not a big fan of paying off the mortgage.
Me neither.
Yeah, because like whatever extra money you put into the mortgage, you're only saving 1.25, 1.5%
Yes.
return.
Yeah.
I put it as a return because that's exactly the interest that you're paying right now.
Yeah.
So it doesn't make sense. Like if you put the money into a mutual fund that yield only 1.5%, you'll be like yelling at the advisor already, right? So if you're putting extra money into your mortgage, you should actually yell at yourself about not using money properly.
People are afraid of that, like our parents, double payments, pay off your house in 10 years.
Well, it's different generation, right? Like
back then, the interest rate back then was like 15, 20%.
Exactly. Then different story. And especially like back then, the inflation was a lot lower, like the people making money in the job salary situation and they can still save money. Nowadays, if you're working in a job, like can you really save money? I don't think so, right?
It's hard.
So yeah, it's very hard. It's completely different situation right now. And the other thing is that, especially we are talking about a lot of real estate investors. And investors, like we're talking about buying investment properties or whatnot, and all these interests that we are talking about are tax deductible.
Yeah.
Right. So a lot of people don't realize that even though if it's 0.25%, quarter of a point, half a point increased in rates, the actual net increase after tax deductible, like a lot of people that we know, they make like $200,000, $300,000 a year, 500, even $1 million a year. So tax bracket is like 46 to 53%. So with those kind of tax bracket situation, if the interest rate increased by 0.5%, and because you are getting tax deduction based on your tax bracket on the interest paid, so 0.5% times, let's say 50% tax bracket, you only increased like 0.25%, which is like maybe $25 a month only.
Yeah, it's very nominal, right? That's the whole real negative interest rate, right? Like if you're not, passing the hurdle rate of inflation after adjusted, you're not making more money. You're losing money every single year. Yeah, exactly. Right. And that's something a lot of people need to understand. So let me ask you this then. What would you recommend to clients who are like, you know what, Brady, Zen, you guys are full of BS. Interest rates are going to be right. I listened to the head of Scotia because he's smart. What would you recommend if they think 8 interest rates are coming in the next year?
Well, you know what, like right now, just so you know, the fixed rate actually standing at somewhere around 2.5 to 2.7%.
Yeah, I think the 5-year bond went up though, so it might be a little bit higher. Yeah,
exactly. So think about this. Even though if the interest rate going to go up, there are 2 major things that people need to know. One is how many times of the interest rate hike will actually catch up to the actual fixed rate right now. Because you got to understand at the very beginning of the mortgage amortization, you are carrying the most mortgage amount. Yeah. So you're saving the interest from the beginning compared to saving the interest from the end is completely different story, right? So you're saving you like lower interest rate at the beginning will save you a lot more interest because of the mortgage principal from the beginning. So
that's a very good way to look at it. Oh, I actually never thought of it that way. Yeah. Yeah, you're right.
Yeah. So even though if it's actually like even though if your interest rate is higher later, but because it's lower from the beginning, overall you're just still saving a lot of money. Right? Yeah. That's first. Second of all, is a lot of people might not understand or might not know that when you have a variable rate mortgage, you can change it to fixed rate, lock it up anytime you want without
ding. I know people don't understand. Banks make more money on fixed, baby. You break that IRD, 5 digits, easy.
Exactly. Yeah. So basically, they can lock in the fixed rate when they see the rate hike. Anytime they want without any penalties. But if they actually get fixed rate right now, they cannot change it back to variable unless they actually pay their very, very heavy penalties.
Yeah. So I was talking to one of our mutual clients today, right? Smart guy, right? You know who you are, Mr. Van Niekerk. And we're talking like how, what if Scotia, conspiracy theory, is saying, hey, interest rate hikes are coming, forces everyone fixed to make more money.
You know what? They actually have something like that. Well, but then you know what? I always tell my clients straight up, like my reputation is everything. Okay, I'm not the type of agents that people know that they're actually chasing after businesses. You know what I'm saying? Like I'm actually more concerned about my reputation, my own brokerage. Because I don't know, maybe a lot of your clients don't know. I'm an owner of a brokerage, right? So I have the luxury to not chasing after individual files,
Yeah.
right? So
But for
basically,
anyone who doesn't know, unintentionally, the mortgage brokers I work with, Brady, the lawyers we work with, and all within a 5-minute drive of one another in the last year somehow. Our offices are across from one another now.
yeah. Well, it meant to be.
Yeah, meant to be, meant to be.
Yeah, yeah.
Okay, cool, man. So my last question for you, right, and appreciate your time here, Brady, is if people do want to change something up, how would they get started, right? Like, let's just say you go on a spectrum of people who kind of believe in the same thing we do, where, we should lever up because I don't think interest rates are coming. What would they do? And also, if like, hey, interest rates are coming, what should they do? And how would they reach out to you to kind of figure that out?
Yeah. Basically, I believe in numbers, right? Like I don't ask people to trust me. I ask them to trust the numbers, right? So what I would like to do all the time is to help people run the calculation first, and I tell them straight up, hey, this is your penalties. If you want to break your mortgage right now, this is what I can do for you. This is what I can make it up for you, and then we put everything on the table. We put everything on the table. We calculate all the numbers. If the number works, then go ahead. I can give you advices. But if the number doesn't work, then you know what? I can tell you when is the best time to do it. When is the best scenario? Okay, so I love to give people more than one solution at a time, so that they know what kind of options they have out there.
Okay, so if now you're calculating the numbers, well, I guess you're going to see, let them make the decision whether they want to fix or not, right?
Yeah.
Okay, that makes sense. So if you're going to fix something, do you think they should fix now or fix later? Because I know a lot of people are asking me that.
Yeah, you know what? Absolutely later. Absolutely.
I agree.
Because as I mentioned, right now the fixed rate is like 2.5 to 2.7%. And a lot of them is actually on the rising trend. So if you can actually pay a lot less right now and fix it up later, then that's the way to go. That's the way that you can save the most money. Because remember, when you have a variable rate mortgage, you can fix it up, you can lock it up into a fixed rate mortgage anytime you want without any penalties.
Cool. Okay. Right? And last thing, what's the running interest rate for a personal home right now and investment property? Give an idea. The difference between variable and fixed.
What do you mean personal loan?
Oh, end user, right? Because the interest rate's different.
Okay. So with own occupy right now, I can get somewhere around 1 point, depends on the mortgage.
Just general. I know what you mean. Okay. Just general.
There's a lot of factors involved, right? So I would say, let's say 1.2 to 1.55 around there.
Okay, so owner occupied.
Yeah, for owner occupied.
This is 20% down, right?
For rental, maybe 1.4 to 2%. Okay, depends on the programs.
Yeah.
So I think it's still like very, very attractive. Yeah.
I will throw money at everything.
I love to.
No, I'll throw money at any real estate if it's sub 3% interest rate. That's a joke.
Yeah, that's true. That's true.
Okay, Brady, thank you. I will leave you with the last words. What do you want to leave with everybody? And I'll, at the end, put your contacts on the screen if anyone wants to reach out to you and your team at Caliber Mortgages.
Yeah, you know what? My last word would be, I would say right now is the best time to use the bank's money to build wealth yourself, right? Because the interest rate is too low. If you don't take advantage right now, then when? Like, are you waiting until the interest rate go up and then you go, oh, see? Yeah, the interest rate really does go up. But you didn't do anything when the interest rate was low, right? So I always recommend my clients that do something is better than do nothing.
Yeah, always.
Right?
I agree. But don't worry, a third of the people will think you're crazy. A third of the people agree with you. And somewhere in the third is maybe they'll be like, Zen and Brady may be onto something. We'll see.
Yeah.
That's always how it is, right? That's always how it is. We just gotta find our people.
Yeah, when I like one thing that I realize is that some people, yeah, you might actually expecting some interest rate hike next year, and then yes, you even though if it's really happened, then you pat on your back and tell yourself that, see, I told you so, right? But the challenge is if you didn't do anything right now, even though you're right, you are not wealthier than yesterday. Right. But if you are doing something right now, even though if the rate goes up and then you have another, you actually crunching some numbers, update your calculation to see what else you can do to move on to the next stage. At least you are doing something. At least you are wealthier than yesterday. I think that's the most important thing. Right.
Agreed. Thank you, Mr. Liao, for your time. I will see you on Thursday.
Yeah, you can. Yeah, I'm going to see you on Thursday. You can share my contact to your group. By the way, you have my.
I have your contact. You're on speed dial. Get out of here. All right. All right. Thanks, Brady. Okay.
All right. No problem.
We'll have you on next time. Okay. Take care. Bye.
Thanks. Bye-bye.
Thanks, Brady. Interesting, right? I bet you didn't know that. And to add on to what we were saying, and what Brady was saying, here's an email from TD saying that their variable mortgages have a fixed monthly cost, right? That's something you probably didn't know. And the only bank I know of right now that actually fluctuates the monthly cost is Scotiabank, right? And this is kind of their contract right here. And it's in the yellow highlighted area. And everybody else from my sources, CIBC, BMO, and RBC all have that fixed monthly payment. Plus, the last thing you see on the little thing I pointed out is that what we talked about in the chat, you can convert your variable into a fixed anytime you want if you're absolutely freaking out, just like Brady and I said in the chat. And I've said this many times before. Banks make more money when you're on fixed than variable, especially if you break it, the IRD, right? So thumbs up if you like my conspiracy theory on Scotia getting you to convert into a fixed rate mortgage right now, right? It's like I always preach a lot. You gotta think critically. You have to probably dig up your mortgage contract and just look at your options available, because these are things you probably didn't understand. And there's more to talk about on this topic, but in lieu of making this video condensed, I don't want to get into it, so you can subscribe to my newsletter, which there'll be a link in the description below, and you can read about how there's skip payments and vacation payments, and this is all before the whole mortgage stuff in the Liberal government allowing you to defer mortgages, right? So I also put Brady's contacts here on the screen if you want another option or some opinion from a good mortgage broker. Now, this is the type of real estate content you enjoyed, then make sure you help us spread the knowledge out there by smashing that like button. But seriously, there's some knowledge bomb drops on this episode, right? And subscribe to the Prime Properties channel, because every week we talk about real estate content that matters the most to you. Because all this real talk of all the people we work with is to be transparent and honest. And by doing so, we hope that whenever you're ready to make a real estate move, you're like, Zen, Brady, you know what? Gonna give them a call to strategize the future, right? Because that's kind of what we do. Now, here's the math part of it. I've talked about this many times before, and I suspect this topic bores a lot of people, but I'm gonna have to talk about it again. Anyways, so there's way too much debt in the Canadian economy, right? No, global economy for interest rates to go up substantially. Everybody talks about how real estate is the only thing that gets affected by interest rate. False. It affects everything else in the economy. It's how central banks control supply of money, right? So companies are borrowing to grow their companies. Governments are borrowing to spend and stimulate. All that borrowed money comes at a cost. It's called debt servicing. The higher the interest rate, the more debt servicing it's going to cost. Like I said earlier, I think interest rates will go up, but I think just to the point where, the economy will show signs of crack and they'll have to come back down. Seen this many times before. My bet, again, like I said earlier, is 3 interest rate hikes by the end of 2023 before we see some kind of crack somewhere and then come back down again, right? Because they don't want the economy to collapse. Nobody has the balls to kind of, go through with it. So here's the math and my rationale. Keep in mind, this is Canada, and Canada is like a drop in the bucket, like right there, compared to globally. We're more likely to take cues from the US than we are to dictate our own terms, but here's the math anyways, right here. The latest pre-pandemic federal revenue, this is the amount of taxes the Canadian government collect, right? So in 2018, they collected $313 billion, with a B, right? You can see right here, directly from Canada's website. And we spent $22 billion on servicing our $1 trillion of debt, give or take. Yes, we're at $1 trillion with a T worth of debt due to the pandemic. The first time I fully grasped this number, I was like, So, this is how much money we are paying to service it, 22% or $22 billion. Here's the kicker on all this. If the debt serving cost goes up 0.25 interest, based from where you are, which is 0, it means that we're doubling our debt servicing from 0.25% to 0.5%. It's a very big amount. So our $22 billion that I can see over here goes to like $44 billion of our revenue. So the question is, how long can we, survive this if we keep increasing interest rates before it gets out of hand where the debt serving cost is greater than all the things we need to actually spend on, like teachers, nurses, and all the other stuff like roads, right? So obviously I did the math. Here's a giant spreadsheet for you because I'm a nerd, right? It's costing us about 7% of our total tax revenue to pay our current debts with the data that I showed you earlier. It kind of lines up, right? And if interest rates go up by 0.25% or double, we're at 14.12% of our revenue, all the taxes collected. Remember, this is interest payment only in the form of a bond coupon, no principal at all. So if we get 3 interest rate hikes or 0.75% to a total of 1% interest rate, that quadruples our debt service. This means the cost of servicing this debt is 25% of our total tax revenue. How are we gonna fund other things? Schools, pensions, right? All that stuff, it's gonna blow up. This is before all of the private corporate side even blows up. That's what I'm saying. That probably happened first. This is the math. And if you understand this, you won't be freaked out by this posturing or forward guidance by our central bankers. And I'm calling their bluff right now. These 8 rate hikes, and even if I'm wrong, my mortgage doesn't increase monthly anyways unless I'm with Scotia. And I've done my due diligence on all the fluffy, catchy headlines that the media is putting out there. And I hope that you have found all this due diligence I have done for you, help you sleep better at night. Nothing to see here. There's a little bit of increase, but nothing to worry about. And if you're looking for real estate help, especially in this kind of crazy macroeconomic world where things are blowing up left, right, and center, interest rates all over the place, and you want to work with someone who understands all of this, you know the drill. Link is right here. You can book a call with me, www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.